Hello, everyone. In today's corporate environment, business often enters into collaborative structures where two or more parties jointly undertake large infrastructure projects, real estate development ventures, oil and gas exploration, manufacturing alliances, strategic partnership, and international expansions. Such arrangements are common because they allow entities to share the resources, risks, expertise, and investment commitments. India's 111 provides the accounting framework to determine when an arrangement is jointly controlled, how joint arrangements should be classified, whether the arrangement is joint operation or a joint venture, and how each party should recognize its share of assets, liabilities, income, and investments. The key focus of this standard is that accounting is driven not merely by a legal ownership, but by the rights and the obligation of the parties under the arrangement. So to understand India's 111 in a structured and practical way, we will first look at the roadmap of what we'll cover today in the presentation. So let's move to the agenda slide and have a detailed look at what we're going to cover as a part of India's 111. Okay, so the key agenda items that we're going to cover today are we'll talk about the objective and the scope. We'll look at the key definitions of the India's 111, concept of joint control, uh, when how organizations do the classification of the joint arrangement, and what are the some of the key principles that needs to be kept in mind to classify that joint arrangement into joint operations or joint venture. We'll also have a quick snapshot on the differences between the joint operations and joint venture, followed by the disclosure and comparison, if at all, we have with IFRS 11. So let's move to the first slide. Okay, now we'll quickly talk about the key objective and the scope of India's 111. So India's 111 establishes the principle of accounting for the arrangement in which two or more parties have joint control. So that is most important. The joint control has to be there, and we'll talk about this in the upcoming slide, that what is the definition of the joint control. Then definitely once we have understood the concept of joint control, then this objective also covers what is the joint arrangement. And then once it has been classified, then the bifurcation or classification of that particular joint arrangement into joint operations or joint venture, and appropriate accounting treatment under joint operations, joint venture, how it is going to be dealt. That is being covered as a part of the India's 111. So joint arrangements are the common in like infrastructure projects, real estate development, oil and gas ventures, and strategic business alliances. So India's 111 ensures consistent reporting of the share control arrangement. So objective is to have a complete understanding that what is the joint arrangement, joint control, joint operations, and joint ventures, and then how accounting is being managed under joint operations and joint ventures. Now, when we talk about the scope here, so it applies to the entities that are parties to the joint arrangement. Arrangement involves the joint control. However, it excludes the investment in the associates, subsidiaries as per the India's 110, and the financial instrument which is guided by India's 109. So we'll move to the next slide. Okay, now we'll talk about the key definitions. So when we talk about the key definition, there are four key definitions that needs to be understood while we define and elaborate on the India's 111. So first is the joint arrangement. So basically an arrangement which has the joint control. So any arrangement which has the joint control is treated as a joint arrangement. Now, what is joint control? Joint control is the contractually agreed sharing of the control requiring the unanimous consent. So, which is like it has to be a contractually agreed agreement, and the control has to be unanimous. It's not like one party is having the control, other party is not having the control, and it does not depend upon the kind of the ownership on the joint arrangement. Ownership can be a different percentage, but if it has the unanimous control over the joint arrangement, then it is to be treated as a joint control. Now, parties which has joint control are either have the rights to the assets and the obligation of the liabilities, which can be a joint operation, or parties have the rights to the net assets of the arrangement, which is a joint venture. So, a joint arrangement, joint control, joint operation, and joint venture, these are the critical terms that we are going to speak quite often while we'll discuss this in DAS 111 in detail in the subsequent slides. So we'll move to the next slide. Okay, so this is the critical slide because this will speak about the concept of the joint control. So joint control is the contractually agreed sharing of the control over an arrangement. So which means that it has to be a contract. It has to be a contract whereby parties agrees to a particular joint arrangement, which exists only when decisions about the relevant activities require unanimous consent of the parties sharing the control. The two key critical terms that we need to understand when we're talking about the joint control is that the agreement has to be contractually agreed and it has to be joint agreement, joint arrangement, and then the decisions on the joint arrangement will be taken unanimously. It's not like one party can take the decision, other party is just a muted party. Both have to be unanimous in taking the decisions. So key feature of a joint control is that contractually arrangement is mandatory. This is mandatory. If the contract is not there, then it's just like by the act of the person, then it will not be treated as a joint control. Sharing of the control, not individual control. No single party can control the arrangement alone. Control is shared is collectively by the parties, and unanimous consent is required. Decision about the relevant activities must require the approval of all the parties controlling the arrangement. So these are like terms, key prerequisites for a particular arrangement wherein we can establish the concept of the joint control. So which means that decision making for a joint control, it has to be required unanimous consent. But if we try to compare it with Ind AS 28, then it was participation but not the unanimous. So control type is the share control. In the Ind AS 28, it was influence only, and arrangement classification is the joint operations or joint venture. But significant influence is required in when we're talking about the associates. So the key definitions that treat India's 111 different from the India's 28 is that the control type, which is like shared control in India's 111 versus the influence only when we're talking about India's 28. The decision is unanimously required by all the party when we're talking about joint control. But in the case of India's 28, the decision is not with the investor. It's like they can do the participation only in the decision making. The arrangement classification is joint operation or joint venture when we're talking about the joint control specific to Ind AS 111. But in the case of Ind AS 28, it's like associates, investment in associates and joint venture. So we have illustrated with the help of example here as well. So example, X owns 50%, company Y owns 50%. Neither X nor Y have direct operation independently. Control is shared. So which means that this is a control shared because they cannot take the decision independently. They are taking the decision unanimously. So we also illustrated one more example here. So company P and company Q establishes arrangement for the highway construction. Ownership is P 60% and Q is 40%. Contract says that strategic decision requires approval of both the parties. Neither party can act unilaterally. So conclusion here is that even though P has majority shareholders or majority ownership, joint control exists because the unanimous consent is required. So which means that legal ownership is not the true indicator. The true indicator is the decision making, which is like a control type, which is like unanimous. And if it can establish contractually that the sharing of the control and the unanimous consent is required for taking any strategic decision or any decision that requires significance control from the owners, then definitely that can be then treated as a joint control. And then operations, and then the classification can be either a joint operations or it can be joint venture. So we'll move to the next slide. Okay, now we have understood the concept of joint arrangement. We have also understood the concept of joint control. Now the next important things that we need to do is the classification between that joint arrangement between joint operations or joint venture. So once control is established, Ind AS 111 requires the arrangement to be classified into a joint operations or a joint venture. So classification is based on the rights and the obligation of the parties and not merely by the legal form. So when we're talking about the joint operation, the rights to parties, the rights to the asset and obligation for the liabilities. These are like individual rights on the assets and the liabilities. Accounting treatment is that we have to recognize the share of the asset and the liabilities in the income expense. We'll talk about that in subsequent slides. But for joint venture, it is the right only in the net assets. So it is that it is being treated as that SPV is there, special purpose vehicle is there, which has been created a joint venture, and then entity in each of the party to the joint venture will have the rights to the net assets of that particular joint venture. And here we have to follow the equity method, which is in line with the Ind AS 28. So, basis of the classification when we talk about, so Ind AS 111 focuses on the substance of the arrangement. The key question is that do the parties have the right to underlying asset and obligations or liabilities, or do parties have the right to result in the entities? So if the rights are there in the individual assets and the obligation or the liabilities, then it is a joint operation. But if it has the rights to the net assets or the results of the entity, then it is to be treated as a joint venture. So there are certain steps which can help us to identify whether a particular arrangement post we have established the joint control is a joint venture or a joint operations. So step one, does the arrangement have a separate vehicle? If answer is no, then no separate vehicle, then automatically it is a joint operation, which means that a legal substance has to be there while we create the joint venture. It has to be either a partnership firm, a limited liability company, or it can be a normal private company, or any arrangement which gives a legal substance to the operations. Then definitely it is treated as a joint venture. But if there is no arrangement as such, then it is treated as a joint operation. If separate vehicle exists, then what we have to do, evaluate the legal form. The legal structure determines whether the assets belong to the parties assets or the itself. So which means that even if we have created a limited company, but still the assets, right to the asset is individually belong to each of the party rather than on the net assets or the results of the entity, then even after creating the SPV, it will still treated as a joint operation and not be treated as a joint venture. Evaluate the contractual term. Agreement may override the legal form. Check whether the contract specifies the direct right to the assets, direct liability, and the responsibility. So again, if direct rights and obligations are to the parties specifically for the particular set of the assets or liability, then it is treated as a joint operations and not joint venture. Even though it has been created as a special purpose vehicle, still the agreement, if it has specifically mentioned that individual parties has specific rights to the assets and the obligation, then it is treated as a joint operations. Consider other facts and circumstances such as the output is purchased fully by the parties, arrangements exist only to the supply parties funds liability directly. These so basically, if at all indicators are there that the entities are doing specifically for their certain set of the assets and liabilities, then they cannot be treated as a joint venture, even though they have created the special purpose vehicle or a limited liability partnership or a limited company. But still, they will be treated as a joint operations and will not be treated as a joint venture. So we have now understood the concept of how we have to bifurcate a particular arrangement between joint operations or joint venture. Now we'll talk about each of them separately in detail along with their accounting treatment. So we'll move to the next slide. Okay. Now we'll talk about first the joint operations. So when we talk about the joint operations, the definition is that a joint operation is a joint arrangement when parties where parties have direct right to the assets and the direct obligation for the liabilities. Each operator account for his share separately. So which means that if both the parties have direct rights to the assets and the liabilities separately as a separate line item in the assets and liabilities with which respect to that particular joint arrangement, then it is a joint operations. So scenario, company A and company B jointly operates a gas pipeline. Company A owns 60%, company B owns 40%. Each party takes his share of the output. Each party pays his share of the cost. So which means that it's a separate line item being identified in the joint arrangement, and each party's have their share of the output as the share of the cost as well. So assets, total assets of the pipeline is 100 crore, liabilities 40 crore. So treatment is that we have to recognize, we are talking about, let's say A in the books of A, how it is going to be treated as. So recognize 60% of the asset in the books of A, which is 60 crore, 60% of the liability of 40, which is 24 crore. Revenue expenses will be proportionally. So the entry that would be passed in the books of the A is asset would be debited with 60 crore, liability will be credited with 24 crore, and balance would either be the equity or the payable depending upon whether they have taken any loans on. If not, then that would be treated as a equity contribution. So this is how the accounting will happen when a particular arrangement is being established as a joint operations, where each parties has separate rights on the individual list of the assets and the obligations. So with this, we are clear on the concept of the joint operation and the accounting treatment. We'll move to the next slide to have a look at the joint venture. Okay, now we have come to the another slide, which is the concept of joint venture here. So when we talk about the joint venture, we have already have a brief discussion that in the case of joint venture, it has to be first contractually being created as a special purpose vehicle, either in the form of the limited company or a LLC or LLP or a partnership. And then it has to be established that the contract is about the net assets of the organization or the net results of the organization. So joint venture is a joint arrangement where parties have rights only to the net assets of the arrangement, typically structured to a separate legal entity. So scenario here, company P and company Q have a JV and P holds 50%, Q holds 50%. JV company owns all the assets and the liabilities. P does not have a direct rights to the assets, and this is a joint venture. So treatment, what we have to do then? So joint venture are accounted for using the equity method, which is in line with Ind AS 28. Investment at the cost is 20 crore. JV profit for the year is 6 crore. P share is 50% of the 6 crore, which is 3 crore. Then what they have to do? They have to pass the entry increasing the investment by 3 crore and share of the profit will be credited as the company's financial statements. So we have now a clear on the concept of the joint arrangement, joint control, joint operations, and joint ventures. We'll try to, again summarize a quick bifurcation or differences between the joint operations and joint venture. So when we talk about the joint operations, so the right is largely on the assets and liabilities, but in the case of joint venture, it is rights to the net assets. Accounting for the joint operations is direct recognition of the share. It is equity method in the case of joint venture. Legal entity required is not necessary in the case of joint operation. It is required for the joint venture. Financial statement impact is gross assets and the liabilities shown. In the joint venture, only single line which is shown as the investment, and it will be increased or decreased. This is the percentage on the profits or the losses, as the case may be. So with this, we are clear on the major concepts of joint arrangement, joint control, joint operations, and joint venture. These are like critical terms and the understandings which are required to understand the concept of Ind AS 111. So we'll move to the next slide. Okay, so having understood the key concept of Ind AS 111 and all the relevant terms followed by the recognition and the accounting treatment, we are now come to the disclosure slide of it. So like Ind AS 110, for Ind AS 111 also, all the disclosure requirements are covered as a part of Ind AS 112. However, we'll quickly try to summarize the key disclosures that are required as a part of Ind AS 111. So disclosures category are significant judgment in classification, nature of the joint arrangements, list of the material joint arrangements, ownership interest and the voting rights, joint ventures, summarized financial information, carrying amount of the investment in the joint venture, share of the profit or loss in the joint venture, joint operation, when we are talking joint operations, share of the assets and the liabilities, commitment related to the joint arrangement, contingent liability in the joint arrangement, restrictions on the cash flow contributions, risk associated with the joint arrangement, changes in the interest in the joint arrangement, related party transaction, and the reporting rate differences. So all these are the key disclosures that needs to be done for the Ind AS 111, and these are comprehensively are covered under Ind AS 112, which talks about all the disclosure with respect to Ind AS 110 and Ind AS 111. So we'll now move to the final slide wherein we are trying to showcase if at all there are some differences between Ind AS 111 versus IFRS 11. So let's move to the next slide then. Okay, so here's a quick summary in terms of the differences between Ind AS 111 versus IFRS 11. So this is fully converged or substantially converged standard without any differences, and it is absolutely in line with IFRS 11. So with this, we come to the end of this Ind AS 111 discussion. We'll move to the final thank you slide and the closing notes. Okay. So as we come to the end of today's session on Ind AS 111, which is joint arrangement, let us take a moment to summarize the key learnings from this important standard. So in today's business environment, we know that joint arrangements are increasingly common as organizations collaborate to share the resources, expertise, investment commitments, and risks. So India's 111 provides a clear accounting framework for such arrangement by focusing on two fundamental aspects. So concept of the joint control has been explained, and then how that the joint control has to be established before it can be further classified into joint operations and joint venture. We also understood that how joint venture and how joint operations are being categorized and what is the accounting treatment. And we also demonstrated with the help of the example. So the key takeaway is that accounting under Ind AS 111 is driven not merely by the legal structure or ownership percentage, but by the economic substance of the arrangement. So I would like to thank all my viewers and subscribers for watching this video. Do let us know for any queries if you have in the comment section, and please share this video, subscribe our channel, and share this video to all the relevant users who want to understand the concept of Ind AS 111. So we're going to come up with a new video very soon. Until then, goodbye and have a nice day.